Hello, my name is Alison Hill. I'm a director at PwC with over 19 years of experience. I work with a wide range of private clients and their advisors, focusing mainly on international issues.
And I'm Natalie Martin. I'm a senior manager at PwC with over 11 years experience advising UK and international individuals, trustees and private banks in a wide range of UK tax issues. I have a particular specialism in looking at tax transparency and tax risk. So today we're going to discuss the new UK Trust Register. We'll look at what trusts are affected, what information the register contains, and who can access that information, as well as the relevant deadlines. And we'll also take a look at related obligations which impact trustees.
We're also going to have a brief look at what future developments may be and how this new register fits in with other tax transparency initiatives and the tax authority's enforcement powers and regulations.
So let's start with looking at what the register is and how it came about. In line with its obligations under the Fourth Money Laundering Directive, the UK government introduced new regulations on the 26th of June 2017. The main impact of these regulations is the introduction of the new UK Trust Register. This register, which is operated by HM Revenue and Customs, is to perform two functions. Firstly, to provide a register of beneficial ownership of all relevant taxable trusts, to meet HMRC's obligations under the regulations to collect the information required. And secondly, to provide a means for trustees to register with HMRC for the purposes of filing tax returns and obtaining a unique tax reference number. As a consequence of this, HMRC withdrew the previous method of doing this, Form 41G, in May of 2017. In addition to registering with HMRC, trustees also have to maintain enhanced records for relevant trusts, and those records can be requested by law enforcement agencies.
So let's look at what trusts are within the scope of the new trust register. The term relevant trust includes all UK resident express trust and any non-UK express trust which has UK source income or holds UK assets. An express trust is a trust established deliberately by a settlor as opposed to a statutory, resulting or constructive trust. The term non-UK express trust may be relevant to a trust with trustees resident anywhere in the world and under any governing law. In fact, such a trust needs to have no connection with the UK other than having UK source income and UK or UK assets. However, non-UK trusts are only relevant trusts if they have relevant UK tax events, as described above. Where UK assets are held by an underlying non-UK holding company or UK source income arises to that non-UK holding company, this will not in itself result in the trust being registerable. This will remove a significant number of non-UK trusts from the scope of the register.
I think it's probably also worth noting that it isn't just trusts which may be caught by these regulations. It will also apply to estates as well as foundations and other legal entities which are similar to trusts. So we'll now take a look at what information needs to be provided on the trust register. And these really fall into two categories. Those are administrative details and beneficial ownership details. So firstly, the administrative details required. These include the full name of the trust, the date on which the trust was set up, the country where the trust is considered to be resident for tax purposes, the place where the trust is administered, a contact address for the trustees, the full names of any advisors who are being paid to provide advice to the trust, a statement of accounts for the trust describing trust assets and identifying the value of each category of trust assets at the date of which the information is first provided. So on that point, it's worth noting that it is the value at which the assets are first settled into the trust, which is important, and it is a statement of accounts for the assets that are first settled. So what that means is if we have a trust which is settled with a nominal value of, say, £100, it is that £100 which will go onto the register rather than the assets which are perhaps contained within the trust at this point in time. So quite an important point there to note, because those two values can be entirely different. So Alison will now take a look at the beneficial ownership details.
So, as you'd expect, detailed information is required for each beneficial owner, including their name, address, and for individuals, their date of birth and also their UK tax reference number or national insurance number. Where you've got a non-resident beneficial owner, it is the passport number that is required. I think this could create some practical difficulties for trustees in obtaining this information, particularly in relation to overseas beneficiaries. It's important to note that the information provided must be correct and current at the date that the register is completed. Therefore, if there are changes between now and the point where the register is being completed or being updated, the outdated information can be disregarded. For example, if a beneficiary is either added to the class of beneficiaries or has been excluded from benefiting from a trust, they wouldn't be included within the beneficial class at the point that the register is completed. For the purposes of the regulations, a beneficial owner in relation to a trust is quite a wide definition. It includes the settlor, the trustees, the beneficiaries. Where the beneficiaries or some of the beneficiaries benefiting from the trust have not yet been determined, you would be required to enter the class of persons in whom main benefit the trust was set up for. Also, within the class of beneficial owner is any individual who has control over the trust.
I think control is one of these terms we've actually started to get used to seeing used in relation to trusts as a result of the various information exchange agreements, common reporting standard. So again, it's another definition we see here. Unfortunately, what we are seeing is that there is no consistency in the definition between the various regulations. And in this purpose for the trust register, control is actually given a very wide meaning. So for these purposes, what does control mean? It includes the power to dispose of, advance, lend, invest, pay or apply trust property, vary or terminate the trust, add or remove a person as a beneficiary, or to or from a class of beneficiaries, appoint or remove trustees, or give another individual control over that trust, as well as the power to direct, withhold consent, or to veto the exercise of a power.
I suppose you would expect that to be the settlor and the trustees would be your main classes, but you may also include protectors within that definition,
exactly,
depending on what powers protectors have within a trust. It is also important to note that the regulations refer to beneficial owners of the trust and any other individual referred to as a potential beneficiary. Here, a potential beneficiary refers to someone named in documents relating to the trust, such as a letter of wishes or any other relevant document that was written by the settlor, which clearly states the intention that someone in particular would benefit from the trust under that settlor's express wishes. It wouldn't include anyone that is named but is unlikely to benefit. I'm trying to think of an example of that, of whether it's someone that was such a remote but potential beneficiary that it's very, so many people needed to die before they would benefit. In those sorts of circumstances, you may not need to disclose that individual.
So we'll now take a look at the relevant deadlines. The relevant deadline will depend on each trust's particular circumstance and including whether or not it needs to register for self-assessment. Existing trusts must register by the 31st of January 2018. Well, that's what we originally thought. However, due to various circumstances, that has been now extended and it will be the 5th of April 2018. As there's no separate registration process for self-assessment, those trusts subject to income tax or CGT, which are new trusts and which need to submit a self-assessment return, will need to complete their registration by an earlier deadline. And again, originally that earlier deadline was the 5th of October 2017. It was then extended to the 5th of December 2017, and then the final deadline was actually the 5th of January 2018. So that has now passed. So updates must be made by the 31st of January following the tax year in which there is a relevant tax consequence. So I think we can see there has been some confusion about deadlines and it can be quite complicated to work out when trusts should first register. Therefore, I think it's important that all trustees think about their obligations and when the relevant deadlines might be.
I think particularly when you're looking at non-UK trusts, that is particularly important because you may not have UK tax consequences year in, year out. So it could be that you only have to register or update the register once every now and again because there's some particular event which creates a UK tax consequence.
Exactly. So we could have a 10-year charge situation. So every 10 years you may have to do something, but not necessarily each year. Yeah.
We mentioned at the start of this that in addition to registering with HMRC, trustees will have an obligation to maintain and enhance records relating to each trust that they control. Enhanced records indicate the same information that is required on the HMRC register, so details of the trust beneficial owners and potential beneficiaries. In addition, trustees entering into certain business transactions in their capacity as trustee will have to disclose that they are acting as trustees and on request provide information about the beneficial owners. The transactions affected are those where third parties are required to perform customer due diligence, such as financial institutions, accountants and law firms, for example. Trustees must also be willing to share the information on request by law enforcement agencies.
So we'll now move on to look at some of the related obligations which trustees and other advisors should be aware of. Since April 2016, most UK companies have been required to formally identify and keep a register of those people who have significant control, PSCs, over them. And this information has to be included on an annual return. Now, this information on the PSCs is publicly available. The regime only impacts UK companies, and so in situations where we have UK property held by offshore companies, that isn't included within the PSC regime. And so for this reason, in order to bring about the transparency of ownership of UK property held by an overseas company, the government announced in May 2016 its intention to bring in a register of beneficial ownerships of UK property held through offshore entities, as well as offshore entities undertaking public contracts. The government's proposals were more specifically set out in a call for evidence in April 2017, which show that the intention is really to align these new proposals with the current PSC regime. And we await further details of this, so we'll wait to see what happens there.
I suppose this means in those circumstances where trustees are not required to complete the register because they own UK residential property but via non-UK trusts own UK property but via non-UK companies, they will still probably be within another disclosure requirement under the property register.
Precisely, exactly. So at the moment there is a carve out under the PSC regime. They're not within the trust register regime, but they're likely to be within this regime if it comes in. And then also we have seen recently the mandatory disclosure regime at OECD level and also EU level, which again may bring in something else. Yeah. And again, the information on that is not yet known.
So again, as Natalie referred to, there are plans at EU and OECD level to introduce a mandatory disclosure regime where there are offshore structures which are not within the scope of other exchange of information or beneficial ownership regimes. These proposals are still at the very early stages of consultation and negotiation, and so we will know more about it hopefully later this year. What is clear generally is that the various initiatives is the drive towards greater tax and ownership transparency is continuing. We're not seeing an end to those developments at either a national or supranational levels. Alongside these initiatives, we've also seen a rise in tax authority enforcement regimes, and we'll now take a look at the UK Revenue's latest initiative, the requirement to correct, which compels taxpayers to review their offshore interests and correct any UK tax irregularities by the end of the requirement to correct window or RTC window, or face new severe penalties.
So I think actually the first point to note there is that there is no new legal obligation to correct a past tax error. What the RTC does in fact do is introduce a new penalty, which is payable by any person who has failed to correct a relevant tax offshore non-compliance by the end of the window, which runs from 6th of April 2017, so it's already open, and it ends on the 30th of September 2018. That end date of the 30th of September 2018 deliberately coincides with the full introduction of the Common Reporting Standard, where we will see full information exchange between the various jurisdictions. And the reason for this is that previously HMRC may not have had the information to enable them to identify tax errors or omissions in relation to offshore structures, whereas with Common Reporting Standard, they believe that they will have significant information which they will be able to use to identify those errors, which is why that date of 30th of September is there.
So relevant. So what is meant by offshore tax non-compliance? This covers a wide range of things, from a failure to notify of a tax liability, a failure to file a tax return, and delivering an incorrect tax return. Liabilities in respect of income tax, capital gains tax and inheritance tax are all within the scope of the requirement to correct, and non-compliance includes any circumstances in which tax has been underpaid, so it doesn't just apply where there has been a deliberate tax evasion, but also can apply where there has been an accidental error.
Yeah, and HMRC expect any correction to be made to cover any outstanding tax which would be within the normal time limits for assessment. So as Alison mentioned, that might be a an error which has occurred despite taking reasonable care, where the usual time limit would be 4 years, a careless error where it would be 6 years, or a deliberate error where it would be 20 years. But what they've done is that in order to allow them to process some of that information we talked about them receiving under the Common Reporting Standard, they have extended these deadlines. And so actually anything which was in time to assess at the 6th of April 2017 will remain in time to assess until 5th of April 2021. So they've extended those assessment deadlines.
So there's quite a sort of a build-up of different legislation which helps the revenue authorities go after people where they believe that there have been errors.
Precisely, yeah. And I think this increased inquiry window, coupled with the increased information which HMRC will receive under CRS and their continued focus on this area, does mean that we are more likely to start seeing inquiries come through.
So it's clear that the scope of both the requirement to correct and the resulting failure to correct regimes is extremely wide and will capture far more than sort of simple errors. Clients, trustees and other advisors will need to give consideration to the general tax concepts which underpin a person's tax position, such as their domicile, their residence position, as well as more complex issues such as the application of anti-avoidance legislation and relevant defences.
Thanks, Alison. So we'll now take a look at what the consequences of a failure to correct are. And I think the first point to note, and I think Alison, you alluded to it earlier, is that the causal link between the behaviour which caused the non-compliance and the penalty which applies has been removed. So a failure to correct will create a situation where a taxpayer will have committed an additional offence on top of the original non-compliance. If a failure to correct is identified, the starting position is that the taxpayer will be liable to a penalty of 200% of the tax due. This can be reduced but not below 100% of the tax due. And we understand, although HMRC have still to produce the guidance on the penalties and how they will operate in practice, we do understand that if following the 30th of September 2018, the taxpayer has to be prompted to make a disclosure, then the penalty they receive, the minimum penalty, will be far removed from the 100%. It's likely to be much closer to that 200% mark. A further penalty of 10% of the relevant assets can be applied in severe circumstances, and that's where the tax loss exceeds £25,000. And there can also be an enhanced penalty of 50% of the penalty which is applied if there is any evidence that there has been the movement of assets to come out of the RTC or the Common Reporting Standards. So if clients have been moving money around in order to avoid those regimes, they may get another penalty on top. In addition to the financial penalties which apply, the revenue also have the opportunity to name and shame those taxpayers, and their names and their details will effectively go on a register which again is publicly available to say that they have failed to pay the correct amount of tax.
I think in those circumstances it's deemed when it's a significant amount of tax is at stake, which for this purpose is actually 25,000.
Yeah.
Which is not necessarily
not
significant.
Always deemed significant, yeah.
The sheer size of potential penalties signifies a real step change in HMRC's approach. At the moment, we have, your penalties if there is an error on your tax return could be as low as 0% if you've shown all the right behaviours. And as Natalie said, the key to the new failure to correct penalties is that they are not in respect of behaviour and that led to the original non-compliance. So whether it's an error that was made in all good faith because of advice, there could still be these very significant penalties. And it is actually the penalties relating to the failure to correct those errors during the period that we have under the requirement to correct period. Obviously that period is now actually quite a short period as it runs only to September 2018. Those who have historic tax liabilities to disclose resulting from innocent and careless errors will be subject to the new failure to correct penalties in the same way that those who've deliberately evaded tax.
So I think it's probably worth thinking about an example for trustees. So if we took the example where trustees have been advised that the settlor is non-UK domiciled, and for that reason they have thought that the trust is not subject to UK IHT unless it held UK assets. Now, if it turns out that actually that settlor is deemed to be domiciled in the UK, then that would impact the trustees' liability, because they would then be subject to UK IHT. Now, where we might have a difference in the penalties which are applied, and where the trustees may have a reasonable excuse for those penalties not applying, is if they have full copies of a proper advice note which outlines the reasons why and the evidence for the settlor not being domiciled in the UK. If, on the other hand, all they have is a statement which says the settlor is non-domiciled in the UK, then that's a different situation, and I think we would see the penalties apply to the trustees in those circumstances. And that could significantly increase the liability for the trustees. Because IHT does not have the usual time limits, so we could have significant amounts of tax due plus those 200% penalties.
So again, coming back to for non-resident trustees, there is quite a need to have a look and examine the positions that they've been taking and the basis on which they are, I suppose, following their trusts, to ensure that they are comfortable, that they have got the right level of advice on file in relation to these things, to make sure that they wouldn't necessarily they would have some defence against the penalties.
Exactly, yeah.
So, as Natalie has said, there are some defences to the failure to correct regime, but they are extremely limited. Therefore, given the potential penalties, which may apply to any errors discovered after September 2018, it is advisable for all those who have an offshore interest and a UK touch point to review their affairs well in advance of September 2018 to make sure that if there have been any failures to report, that these can be corrected prior to that deadline.
And I think in our experience, it's fair to say it's not uncommon to see mistakes are made given the complexity of the UK tax legislation. And where mistakes are identified, as you mentioned, they should be disclosed as soon as possible to HMRC. Now, the method in which taxpayers may do that will vary depending on their circumstances. For some, it may be just to amend a tax return. For others, it may be speaking to their relationship manager in the high net worth unit, and perhaps for others using the Worldwide Disclosure Facility, which is an online disclosure facility which HMRC have made available for that purpose. And then for more serious cases, you may want to consider whether or not using a contractual disclosure facility, more commonly known as the Code of Practice 9, would be appropriate. But again, as I said, it does really depend on the individual circumstances of each case.
An interesting sort of example of that is recently with a client where we had gone to the client's CRM, so their client relationship manager, and we were then quizzed why we weren't using one of the online disclosure facilities. So it's definitely clear that the Revenue's preference is for people to use online disclosure facilities to make any disclosures. Yeah,
and I think on that point it is their preference, but there is no legal obligation for clients to use that facility. But in some circumstances it is the appropriate one to use, and there may be benefits to using it, such as it is a defined process, so it may be dealt with quicker than it would be if you use an alternative method. So again, it does really come down to the circumstances of a particular case.
It's also worth considering what to do where there are perhaps areas of uncertainty. There are many areas relevant to UK tax law which may be considered ambiguous or open to interpretation. The difficulty that the RTC and FTC regimes present is that by effectively removing any consideration of causal behaviour when considering the application of penalties, a client who has taken advice and who had a supportable filing position relating to a subjective point may find himself potentially subject to failure to correct penalties should that position later be challenged by HMRC and conceded for whatever reason.
And I think there, again, it's probably just worth emphasising that where there are situations where perhaps it's not black and white and a judgment call has to be made, it's really important that those clients and their advisors do take a look at things again and look at the position they took and think whether or not the original advice still stands, whether there's been changes, or whether or not they do want to think about perhaps a second opinion, and in appropriate circumstances perhaps even going to counsel on a particular point.
Yeah. And I suppose good examples of those sorts of issues are, again, the domicile position of settlors and the application of anti-avoidance provisions.
Yeah, precisely. So that brings us towards the end of our WebEx, and I think it's clear from our discussion today that the complexity of the UK tax law, increasingly tough sanctions for errors, as we've discussed the FTC, RTC regime, and the introduction of disclosure beneficial ownership regimes means that it's really crucial that clients do now take a look at their affairs and make sure they are receiving the right advice. on their affairs. And I think given the wider economic conditions we're continuing to see in the UK and outside of the UK, and the political debate at the moment, it is likely that we will see a continuation of this trend. Before we finish, it's probably worth reflecting on a couple of action points which trustees, clients and their advisors may want to think about.
So I think key actions in relation to the trust register: trustees must ensure that they understand their registration and reporting obligations, and then that they meet them by registering at the appropriate times. Anyone with offshore interest should review their affairs in advance of 30 September this year to ensure that there are no errors or omissions, or where there are questionable areas, say areas of doubt, that they consider these further and perhaps take further advice on them. Where errors are discovered, it is recommended to make full and prompt disclosure to HMRC. And also, I suppose, always important, but making sure that you retain any documentation and correspondence which shows the basis on which decisions have been made, particularly where they relate to offshore tax ambiguity, to ensure that it is clear that it was reviewed and addressed properly.
In a situation where an EBT may have an IHT liability relating to a year earlier than 2016-17, is this a relevant liability for the purposes of the trust register? So I guess the question there is, if we have, say, a 10-year charge or similar, which is due, which would have fallen due before 16-17 but hasn't been paid, do the trustees of that EBT need to register? And I think that here we are quite clear that the guidance is clear that it is only 16-17 liabilities which would be relevant liabilities. So in those situations, there wouldn't be a need to register under the trust register. However, clearly, if there is an outstanding IHT liability relating to an EBT, then that would probably would be within the remit of the requirement to correct regime, and therefore something will need to be done to correct that position before the 30th of September, although it won't be required to complete the UK trust register. Just come in, is SDRT a relevant tax? Pretty quick question to answer. Yes, it is a relevant tax for the purposes of the trust register.
I think that therefore means that when a trust has suffered SDRT on the purchase of shares, that will actually bring them into the requirement to register, because they've suffered a relevant tax. And if it's been suffered in buying shares in a UK company, they have a UK asset. Sorry, someone has asked me to repeat the answer in relation to the situation where you have a trust that owns shares in an offshore company that in turn owns a UK residential property. In this case, it's the view of HMRC that there is a relevant tax, if there is a tax liability, then the look-through provisions which would deem the asset to be that of the trustees would mean that there is a requirement to register. So the situation that we're looking at here is for the 10-year charge date or exit charges where inheritance tax would be due by the trustees in relation to that underlying UK asset. So we have another question regarding the interest in possession trust, and to the extent that income is mandated to the trustees, would you still have a requirement to complete the trust register? My understanding is that yes, you would under those circumstances, because there is still strictly a liability on the trustees, albeit that from a practical point of view, that may just be reported on the individual tax returns rather than on the trustees' tax returns.
Oh, sorry. So we've just been asked to confirm again just the deadline and whether or not it's 5th of April. And I think the slide in the webinar would have said the 5th of March. I think that there was an error when we were speaking which said the 5th of April. It was 5th of March, which was yesterday. So we're just being asked a further question on SDRT. I think this is similar to the question we've been asked before. So if it is incurred as a result of an investment portfolio. And this is a question which has been put to the Revenue, and they did consult with their SDRT policy team and their technical team, and they haven't put anything in the guidance so far on this, but we do understand that whilst administratively the tax is paid over to HMRC by the third party, so by, say, a nominee, the tax liability ultimately is the trustees, and the trustees do financially reimburse the third party who pays over that SDRT. And therefore, the HMRC's view is that in those circumstances, they do see that SDRT is the liability of the trustees, and therefore registration would be required.
Another question has come in regarding the requirement to register beneficiaries of complex offshore trusts, which indirectly own UK property. As I mentioned, this will depend on whether there is a relevant UK liability arising to the trustees, and I suppose the emphasis there on trustees rather than on the beneficiaries, because it's the need for the trustees to have a liability. For example, the inheritance tax liability, which is now due in relation to UK residential property, even if it's indirectly held. Another question is coming about what if we can't register as an agent? I know that there have been some technical difficulties over this, and a need to get that registration. I have to admit I'm not sure exactly what the sort of the current view on this from HMRC is, but I would imagine that you would need to find someone that is able to register and therefore is able to undertake those registrations for the relevant trust. But certainly I'm aware that there's been quite a lot of negotiation with HMRC in order to establish agent status.
I think we're getting a few questions on sort of very similar areas. So we'll maybe just sort of state that if we have a situation where there's a non-UK trust and there's a UK resident settlor, but the trust itself doesn't have a tax liability and doesn't need to register for self-assessment, then there wouldn't be a need for the trust to register. It doesn't matter that there may be something which means that the settlor needs to prepare the tax return and declare some of that income for whatever reason. It's the test as to whether or not the trust needs to register is whether or not the trustees have a relevant UK tax liability. So we've just had another follow-up question, which again is in relation to UK property point, where we have a trust which holds UK property. Can we confirm if this relates to UK residential property and not commercial property? Again, I think the point is if it's held directly or indirectly, and if it's indirectly held, whether or not there is any liability which can be attributed to the trustees. If there are any questions, you have any queries, please do feel free to get in touch.
Yeah, I think we have covered all the questions now that have been asked. So thank you very much for your time today. It will be possible to get a copy of the video screening on demand from tomorrow. And if anyone has any additional questions, then please do get in touch and we will see what we can do.
Thank you.
Thank you.